Those of us who have kids file our kids on our tax returns as our dependent. And there are certain credits out there that are available to parents, right? And I'm going to run down those really quick. Hello, this is Business Combos and Coffee, and it is Spiceda here. Okay, y'all, it's a Friday, and this is part 2 of paying your kids. Now, if you missed part 1, I'm going to give a really brief discussion on it. I'm just going to go because I know many people will watch this on a replay, but this month is the month of August. In August, I see my timeline full of cuties that are going back to school. And so my team and I put together this series on paying your kids. So last week, I had the conversation on how do you pay your kids? So if you missed last week's video, subscribe to my YouTube channel, Spiceda Jackson. I will try to put the link in the comment section so you can easily get to it. But subscribe to the YouTube channel. It was just last Friday, and you'll find how to pay your kids part 1. And I'm going to just already give you a spoiler. Can I pay my kids? Is yes. But how you do it and where you start is all in the YouTube. So subscribe there. Okay? So today, this kid thing, it's on my mind constantly because, I'm a mom of 2. I have a son who's 6 years old. My daughter's 4 years old. I began entrepreneurship with no kids. Okay. By the way, I'm Spiceda Jackson, founder of X Financial, CPA. We do businesses Tax Plus 365. We focus on working with small business owners because small business owners is the heart of community. And we believe that when you guys thrive, the entire community thrive. And when communities thrive, families thrive. And when families thrive, it creates generational wealth for everyone. And that's what we want to do. Those of us who have kids file our kids on our tax returns as our dependent. And there are certain credits out there that are available to parents, right? And I'm going to run down those really quick. Now, we have the child care credit. We have, which is paid for dependent care. We have the child tax credit, which is for our children 17 and under. We have the earned income credit, and we have the American Opportunity Credit, which is for kids that are going to college. Now, I don't know if you guys knew this, but you have to make income to qualify for those credits. You also can't make over a certain amount of income, and there are income limits when it comes to credits. Credits you have to qualify for. And what are credits, Spiceda? Y'all ask me, what are credits? I hear you in the world saying, what are credits? Well, credits is free money that's offered to you from the government. Now, the credits that I just ran down were related to people, taxpayers with kids. And I'm talking specifically to entrepreneurs. Entrepreneurs that have kids. Now, sometimes in entrepreneurship, you may have a lost year and you have no income. If you have no income and you're required to have income to qualify for a tax credit, meaning it's a refundable credit, or a non-refundable credit. Non-refundable credits are credits that basically you have to use you can only use non-refundable credits to pay taxes. I hope I'm not getting this mixed up because I'm going on the fly, but sometimes I get it mixed up. But non-refundable credits are used, it's money that the government gives you to pay income taxes. Refundable credits are money that is given to you and you don't have to use it to pay taxes. So non-refundable credits are restricted and they can only be used to pay income taxes. And if you have no income taxes to pay because you had losses in your business, then you don't qualify for those credits, right? And let me be clear. Now, the income taxes is to pay income taxes and not usually self-employment taxes or employment taxes. All right. Now, to qualify for tax credits, you must have income. Most of them. I think it's all of them, but to qualify, you have to have income, and there's an income cap. So there's a minimum, meaning minimum, you got to have income, and maximum, you cannot earn income above the maximum for that credit. So if you can't make over $250,000 to qualify for the credit, then if you make over $250,000 of adjusted gross income, then you don't qualify for that credit. Or if you make more than $50,000 of adjusted gross income, you don't qualify for the credit if the credit is capped out at that income limit. Okay, so why am I saying this? I'm saying this because as entrepreneurs, sometimes we have good years and hopefully we have more good than bad, but there are times that you have a bad year and you're taking care of your family, taking care of your kids, etc. But you may think that you're doing yourself a service by, showing that you have a loss because you don't pay any taxes. That's not always a good idea. Or by incorrectly incorporating. Let me say that again. Incorrectly incorporating. If you incorrectly incorporate, you also may not qualify for the tax credit because some credits are reliant on you having a specific type of income. So if you're an LLC, you may qualify, but if you set yourself up to receive all your income as an S corporation, you may not qualify. So, you got to be careful and not be out, not applying tax advice to your personal situation and to your business that you heard from a friend. So how you pay yourself is very, very important in business. I'll see y'all next Friday. I love y'all. I am Spiceda Jackson, the accountant that you want to work with when you want to increase your profit, reduce your taxes, and just have a successful business. Y'all. All right. Have a good day. Y'all have a blessed weekend. Bye.